Okay, good afternoon, everybody. It's already 2 um, 2:07. I don't want to keep people waiting. We want to respect everybody's time and punctuality. So, very good afternoon to everybody who's joined in. We don't have everybody in yet, but we're going to get more people coming in, joining in. So, appreciate if you could do us a favor so that we know who you are. Please put your actual name, all right? Put your actual name in your description so that we know who you are. Also, if you can, please put, if you can answer to Hazel. Hazel will be PMing you, private messaging you to find out about you so that we know who is the audience that we are speaking to today. So please help us out in that way as we are sharing this um, valuable information with you. So please help us out also in that way. Thank you. So without further ado, uh, my name is Patrick, and I wish you a safe viewing of today's webinar from wherever you are. And thank you for taking your time out. I'd like to actually pass it over to um, Miss Adeline Tan, um, who is our upcoming Chief Agency Officer, Ms. Adeline Tan from R.I.C.H Asset Management, to actually open today's session. Ms. Adeline?
Hi. Can you guys hear me? Patrick, can you hear me?
Yes, I can hear you.
Loud and clear, right?
Yes, very good.
All right, thank you, Patrick. Thank you. Good afternoon, ladies and gentlemen. I'd like to take this opportunity to wish everyone a great, happy 2021. All right. Allow me to share with you the humble beginning of our associate business partner. All right, SynergyPlanners. SynergyPlanners has been with wealth management industry for more than 20 years. All right. This business is widely spread the wing through the whole Malaysia. All right. Kudos to Patrick and Hazel on your achievement and leadership. All right. We hope to have a longer relationship with us in R.I.C.H Asset Management. Okay. As we all know, the past year has been a challenging, and as we step into the new year, these challenges continue in what we have now widely accepted as being as a new normal. All right. The pandemic has forced changes in the way we live and work that exists long after medicine science made the virus manageable. This might sound like problems, but it is an opportunity. Okay, in meeting the expectation of the market, R.I.C.H Asset Management has recently collaboration with JP Morgan Asset Management to launch the first Sharia Global Sustainable Disruptor Fund in Malaysia. Okay, this fund invested into the first ever in market, yeah. Okay, so this fund invested into the key beneficiary for long-term structured growth team such as digitization, financial evolution, fueling good sectors, healthcare innovation, and energy revolution. All right, the investment process is fully ESG integrated, and the model portfolio is rated single A to triple A based on the MSCI ESG rating scheme. All right, so without further ado, I will pass the floor back to the MC, Patrick. All right, as the next speaker will elaborate more on the new fund with R.I.C.H Asset Management. And thank you, and stay tuned to the end of the session. So pass it to you, Patrick.
Thanks, Adeline. Thank you very much.
Hi, everyone.
So, let me just adjustments here. All right. So thanks, Adeline. Adeline actually gave a sneak preview of what we're going to offer towards the end of the session. Malaysia's first ever Sharia Global Disruptor Fund, and it's ESG compliant. So it's a very, very exciting thing for Malaysia, especially in our new normal. I'm sure all of you in this webinar have been through hundreds, I think from now, it could be almost hundreds of hours of online events We're getting used to this new new media. All right. And so without further ado, I just want to take you through a little bit about Synergy Planners. As Adeline has mentioned, we are a wealth management firm established in the year 2000, since the year 2000. So last year was our 20 years anniversary. Yay! Um, and we comprise around 30 wealth advisors nationwide, East and West Malaysia. And we have about 400 clients who are both corporate clients and also retail clients. And we manage total asset under management of about 74.2 million ringgit. So back in 2016, we were the firm that was most awarded by R.I.C.H Asset Management and also the fastest growing R.I.C.H agency in East Malaysia. And we have also got some media coverage in the area of financial services, retirement planning, and of course, career development. So this is our management team. I've got 3 agency managers that help me run the business. Kavinesh, Kevin, and Hazel, all 3 of them are, of course, in this Zoom. You can say hi to them. Also, this last year, I think we don't have to talk too much about it, but I think there are some realities that we have to we have to accept that life is going to change. It has been all the while for the last how many years we've gotten used to a certain way of life, but in the last 12 to 18 months, things have started to change. And now we have to adjust to a new normal. So this year, 2021, we have a stronger base to move forward because we have a vaccine in place. We have several vaccines in place. We just need to make sure we get vaccinated, and we have to follow new SOPs in order to survive and live and to move on. So let's go on to the 2021 market outlook. So let me give you a background of what I've done. The whole of last year, because we were all in lockdown, we experienced a very sharp V curve, correct? I'm sure all of you who are experienced investors know about the very pronounced V curve that we had last year in March, April. And so since then, we actually have, for the first half of the year, we managed to do a lot of switching and rebalancing of our clients' portfolios. And some of you who are already in, you know this because we've been engaging with you for a lot, especially last year, more than we have done in the last 5 to 10 years. So we did a lot of last year specifically because the market was so favorable. The market was so favorable. So while, as Warren Buffett said, Warren Buffett made this quotation, the time to invest is when there is blood on the streets. Okay, so without having that mental picture, but really it's about having maximum pessimism. Okay, so the term is maximum pessimism. That was last year. And that is how we had the pronounced V curve. And I'm sure many of you, if you didn't invest with us or through us, you would also have invested and your consultants would have called you and said, this is the time to go in, this is the time to go in, So, and you would have made a lot of profits from last year's down and upward swing. And of course, in the second half of the year, we saw a lot of markets doing a good and solid recovery. So last year was actually quite phenomenal when it comes to investments. It was a lot of things for us to handle last year in terms of how to help our clients invest, where to invest. So we spent a lot of time looking at markets and watching how things develop in order that we can help our clients optimize their investments. All right. So this market outlook is actually a combination of the last few weeks that we have spent looking at the opinions of these fund managers and their information is actually public. But what we've done is we've actually compiled it and taken out the important points, the salient points that will help you make better investment decisions for the year 2021. All right. So of course you recognize all of these brands. I don't have to go individually into these brands, but you can actually see them. All right, and recognize them. So let's begin with, this is one of my favorites because I worked in Citi before. So let's begin with Citi. But I must let you know that the amount of points that I bring out, they are not all the same amount. So there are certain points that are quite repetitive in others. I try not to repeat myself. But you know that along the way, there are some important points. I will highlight it to you. But those that are repetitive, I would have discarded. But it doesn't mean that they didn't say it. All right. So this is what Citi has to say. Primarily, this is their summary. They said they actually brought out the trifecta of development, the three factors of developments to support the new economic cycle. So they referred to everything that happened from 2021 forward as what we call the new economic cycle. That's why the term the Great Reset comes, all right, where a lot of economies had gone through a big reset last year, and things had to start basically from zero. So the new economic cycle will depend on three factors. And this was, of course, done in December, late December. So at that point of time, we still had Trump putting in the court cases, so on and so forth. And so at that point, they didn't know who the new US president would be. Now we do. All right, so that is why I put a double tick there. Also, an efficacious COVID-19 vaccine. This is what will determine how the economic cycle will move forward. We know we have this already, and it is being rolled out in stages. Of course, some roll out and some roll back, but I won't go into that. But it's a work in progress. And so you've got two of the factors that are already in place. However, the third factor is still being played out. Okay, sufficient fiscal and monetary stimulus that will support corporations in their recovery from last year and in their growth in the coming years, because it's going to be tough for them. So we need to ensure, like Citi Gold here says, we need to ensure that there is enough fiscal and monetary stimulus by the governments, by the central banks around the world in order to spur the recovery. All right, in order to support the corporate recovery of all the different industries and sectors that are supporting growth. So this was the compilation of what Citi Gold had said that will support the efforts moving forward. Some of the factors that they spoke about, I will also cover in the other fund manager reviews. So let's move on to BlackRock. All right, BlackRock. So we've got Tony Despirito, who actually gave these three factors. Give me a second. Yeah. So reactivated. We expect investors to begin to step beyond obvious winners. That means you've got to already look at specific areas to be able to invest in other specific areas and deploy cash into beaten down sectors. We all know how how much Tesla has grown in the last 12 months. So that is one of the areas that we can look at. In 1 second. Okay, so let me bring this closer. So generally speaking, this is where active investing has an upper hand over just index tracking. So it's very important for us to know which are the industries, which are the sectors, which are the countries to be able to focus on, possibly on a month-to-month or a quarterly basis for the next near future, rather than just wait for S&P to grow, wait for a Bursa to grow or Kospi to grow. All right. So value comeback would be referring to cyclical stocks. Now, I purposely highlighted cyclical stocks because this is an area where a lot of fund managers have highlighted. So it's something to take note of. The cyclical stocks, which have strong ties to economic growth, of course, they now have low valuations. So they'll be the ones to bring back a strong bounce. Also together in the US, in China, and of course the larger parts of Asia, you will see cyclical stocks slowly making a comeback as the markets get stronger and start to open. So I will cover cyclical stocks again in the next few slides. Now, dividends to deliver as well. All right, so this is what Tony also covered. As long as interest rates remain lower, and around the world interest rates are all at record lows, company dividends will likely provide better income than bonds. So this is something that you can look forward to when you look at corporate investments, investing into corporates. All right. So there are three factors that he spoke about. The new nominal, we see stronger growth and lower real yields as the restart accelerates and central banks, they look at the rise of nominal yields. Okay. Even as inflation expectations climb, inflation will have a different impact. So they want to underweight on government bonds. So that's BlackRock's view. They know that governments will be going through a tough time. So of course, globalization is re-looked at because of the amount of separations that has happened. So we were accelerating into globalization at one point, but now we are looking at a lot more decoupling. All right. Turbocharged transformations. The pandemic has added fuel to pre-existing structural trends. All right. So you will have a lot more separations, a lot more inequality. So we need to just be very important. Very importantly, we need to look at what are the sustainable assets amidst a growing societal preference for sustainability. So the word sustainability is now getting hotter and hotter. So we will cover a little bit more about sustainability, ESG, towards the end of our presentation. Okay. Now, Forbes. So Forbes actually covered a lot more US-centric areas, but if you look at US last year, they also had S&P all-time highs. So it is very important, and we also maintain that we need to focus on US growth, especially with the new Biden administration. So COVID-19, these are the areas, the themes that focused on COVID-19, vaccine progress. So one of the things that was brought up, we were listening to Market Outlook by Adam Khoo. I'm sure many of you are familiar with Adam Khoo from Singapore. I think he's Malaysian, but he is actually based, not Malaysian, huh? Okay, he's not Malaysian, he's Singaporean. So Adam Khoo is one of my gurus, and he did speak about with the rise of the vaccines going out, if you want to try and buy into vaccine stocks, right, don't bother, because the stocks have already been, the valuations have gone up. All right, the valuations have gone up. Now I'm talking about particularly stocks, okay? I'm not talking about industries. So forget trying to chase after vaccine related stocks like Pfizer, Moderna, and all that. Forget it, because they're already very highly valuated. But he did mention companies that are developing the syringes. Those are the second liners. So as the vaccine progresses, the need for syringes, for those type of medical equipment will also go up. So he talked about that, and I thought that was brilliant. So these are some of the ideas that are in the market that we can actually take note of if we are in that interest of buying particular stocks or buying particular tickers. Number two, political gridlock in Washington, D.C. Okay, we've already passed that. We now have, now we're looking at second stimulus, and Biden has already announced the second stimulus. Was it 4 trillion? Yeah, a single digit trillion number he announced again, all right? About 2 weeks back, all right? A second stimulus to stimulate the US economy, to get people going. And he was also looking at definitely cash checks to the US citizens, issuing cash checks for them. So Fed is also probably going to keep their interest rates low to spur growth. And of course, the great rotation. The great rotation means moving equities, moving from bonds and fixed income into equities, back into equities. So the great rotation is actually it's already happened last year, and will continue to happen because the Fed is keeping the interest rates low. And so investors will always want to chase for higher yields, and therefore they will go for the markets where they can get better yields. Of course, again, economic growth and corporate earnings are very much in the spotlight, and they will be looking at it very thoroughly quarter to quarter. So that's Forbes. So Morgan Stanley. So these are the 6 takeaways from 2021 Investor Strategy Outlook. Global earnings are set to surge. So let me take your attention to the top right bar chart, where they compare the indices, the MSCI emerging markets, MSCI Europe, topics, and S&P 500. You can see the light blue is the highest. 2022 may not be as hot because this year is what we call the bounce back. Last year, all the dark blue, the not so dark blue, but the medium blue, all right? Everything was negative. Light blue, we are looking at positive. Everything is above 20% growth across all regions. Okay, that's the EPS growth. So that is Morgan Stanley's forecast, and therefore if you want to invest, guys, for this year, Morgan Stanley says this year you're expecting growth. So you don't want to wait until June, July, because you're only going to get half the pie, okay, half of the year. You want to invest in January so that you can get the EPS growth through the funds that you're investing in for the entire year. You get what I mean? So don't wait and see anymore. The time to come in is now, all right? Valuations are reasonable but uneven. So again, this is where a consultant is very important, because you need to know which are the areas, which are the sectors, which are the funds that are potentially going to grow, all right? Personally, if you ask me now, when you're looking at this part, let me just put this in. I don't see some markets doing that well yet, because there are some areas that need to be addressed. I'm Malaysian, but I don't see Malaysia doing that well this year, okay? As well as investing in other markets. So I'm not saying Malaysia will not do well. I'm just saying if I were to invest my own money, I would invest it in overseas markets where I know I would get a better return for my investments. All right, so that is valuations are reasonable but uneven. So it may not be even across all sectors. It may not be even across all markets. Okay. Follow the early cycle playbook. Okay. So early cycle playbook, you want to come in early, like I mentioned earlier. Europe is finally ready to rebound. Okay. So this one for me also is a question mark because I've got to see the numbers. But Morgan Stanley forecasts that Europe is ready for a rebound compared to the last few years when, of course, they had a lot of issues with cross-border migrations. They had issues with, of course, trade policy, trade issues, bilateral trade issues with the US, you know, so on and so forth. And of course, their biggest headache was Brexit. Now Brexit is confirmed. They are ready for a rebound. So Europe is ready for a rebound. Okay. Reaching for yield isn't a stretch. That means that you throw stone, you can get returns. So they are telling you, don't hold back and wait. Start to put your investments in different places. Give me 1 second. Okay. Mixed bag. It's a mixed bag for other asset classes. So you may get some profits in different asset classes. Some may not be doing well. So you need to make sure your diversifying effect is there. So don't put your eggs into one basket. All right. So those are the 6 points from Morgan Stanley. Now, Vanguard, maybe some of you may not be familiar with Vanguard, but Vanguard is actually huge overseas. All right. And I like their data because they provide a lot more actionable data, you know, actionable information. So pre-COVID, the pre-COVID-19 trend, you can see from December 2019, that was actually the trend. Then in June 2020, you can see the baseline, the V that we spoke about. Many of you already know this V. So that was the baseline that they look at. And moving forward into December 2020, and of course the dotted line. So this is their prediction on the recovery path for 2021 and forward. So they've got the upside and of course a downside. Therefore, you will see that downside paling, it will grow towards the end of this year. So you want to buy when it is still negative. There is it's a general line moving upwards, moving north, but you want to buy when it's cheap, right? So the important thing is to take action quickly. So this is Vanguard's recovery path. Now they're talking about sectors now. Let's go a little bit deeper. Health outcomes actually will drive the consumer behavior, and that will in turn drive recovery. So this is important to note. Vanguard is making an assertion that when we talk about herd immunity and the reluctance of people wanting to go out. Okay, that's the second circle. So that will result in an unemployment gap. Okay, that's the third circle. So that will, of course, determine the economic activity and how fast we will all bounce back. So they're looking at 60%, 65% of the population when they did this threshold. Let's see. Okay, so this was one of the key takeaways from Vanguard. This is what they foresee the growth rate for this year, the economic growth rate for this year. They see a 5% growth rate in the US and Europe area, including UK. And of course, emerging markets, they're looking at a 6%, not very different. But okay, the theme of today, I'll be talking a lot about China because we are very happy with our investments in China as well. And even Vanguard has got almost double than the rest of them. So so China, you can see the across the border 5, 5, 6, and 9. So I'm very excited about this particular chart that I saw when Vanguard came out with their market outlook. I got excited on this particular graphic. And you can see based on the previous one, 2020 and 2021. See, China last year also still can make money. Although Wuhan was epicenter of everything else that happened in the world, they still managed to make money. And of course, we along, RHB and SynergyPlanners, along with a lot of other China-based fund managers, all helped our clients make money last year. And of course, growth is expected for 2021 to make up for the lost ground of last year. And inflation should be tamed, and of course, the job market is set to improve. So important part again, earnings growth for the companies that will support the growth in the job market. Okay, so these all need to work together. Market returns may be modest, but you still also have good market returns. The important part is how we take action, which sectors we go into. HSBC. Okay, this was actually quite good also. So they've got 3 scenarios, very optimistic, best case, and a pessimistic scenario. So widespread vaccinations early in 2021. So vaccines are already being done in the millions around the world. Consumer demand, of course, a lot of demand has already come back because things have gone online, and that's very good. So the bounce back is there. So very optimistic. We look at fully cyclical stocks. So cyclical stocks are mentioned there. Look at some value stocks. Those who bought Zoom last year, very good luck for you. And high yield bonds, local currency bonds, okay, emerging markets, local currency bonds. Okay, those are the assets that HSBC favors. And let me cover pessimistic first. So if the vaccine ineffectiveness continues to spread, like a lot of the bad news with Norway and Pfizer, so if the uptake is poor, okay, with a lot of news spreading, people are saying, oh, they don't want to get vaccinated, they would rather have stricter SOPs. That, of course, will stifle the growth of, the development of the herd immunity, and that will lead to more lockdowns and lesser economic activity. Remember the 3 parts in Vanguard. So this would be the pessimistic scenario, okay? But again, it's a pessimistic scenario. So they would look at, HSBC would look at defensive stocks, government bonds, gold. Again, like last year, gold did a run, then came back down, and safe haven currencies. So the base scenario, let's look at the base scenario, okay? So we don't want to go too left or too right. The base scenario would be consumer demand actually meets forecasts, mild cyclical stocks. We look at mild cyclical stocks, growth stocks, high yield stocks. So high yield bonds, investment grade bonds, and emerging markets, only the hard currency bonds. Let's see. Okay, so HSBC forecasts that Asia will lead the world's recovery. Well, it's not rocket science. China is part of Asia. Mainland China, so their forecast is 8.5. Vanguard was 9, not far different. So it's good. When you've got 2 or 3 people who agree on a particular outlook, that's good. Here they forecast US only 3.5, although Vanguard forecasts 5. But I want to show you something. You see beside the US, you've got UK 4.3, and of course UK is dealing with Brexit. But the silent killer is actually on the other side of US, which is 3.2, which is Japan. Now, some of you who have tuned in to my earlier sessions will remember I always talk about a dark horse, okay? And I always spoke about our RHB Entrepreneur Fund that invests in Japan. And last year also, besides mainland China, I'm going to show you the chart later. Besides China, Japan also did well. So, but you don't hear much noise about it. So I'm going to show you later why Japan is also one of our happy picks. All right, and you can see here HSBC also forecasts strong growth for Japan. So again, like they said, you want to make sure you're in the right places, in the right sectors, in the right countries. So do take note of this. Now, reset Asia, now since Biden is in, Trump is out, okay, so we can look at a more positive cross-border bilateral trade. So the trade bloc reset is already there, and it's actually even bigger than the US Canada agreement, US Mexico Canada agreement. So this one we expect to be a good backbone to support Asia's growth rate for the next 2021, 2022. All right. But we need to see how the rest of Asia picks up as well. So cyclical stocks, again, familiar words. For cyclical stocks will outperform. And you can see cyclical sectors versus defensive sectors. So I'm going to cover a little bit more about cyclical sectors in a short while. Here you have it. So when you look at cyclical sectors, these are the areas you want to focus on. Industrials, all right? Industrials. Materials, okay? So all the different types of companies, sectors that are dealing with material, with construction, with development. So these are the areas. And consumer discretionary. So different from staples, consumer discretionary. So look out for funds that actually are focusing on these sectors around the world. Of course, you've got in China, enough. It's good, all right? We'll show you some of the funds. In US, in Japan, you'll find funds that are cyclical stocks like this. Okay, in Malaysia, if you want to go for these funds in these sectors, I guess also can, you know, but again, you want to not focus too much. All right, if you got opportunity to push it overseas, do take that opportunity. Again, that's my little input. Tech is here to stay. Hello, yes, welcome to the tech world. This is how we're going to communicate and connect. Even our clients are investing with us, all using tech. So we encourage it, and it's an aspect that we need to start to embrace. All right, so tech, even the tech industry, the tech stocks, is all here to stay. All right, sustainable investments will be the new normal. So we're going to cover a little bit about it in the fun feature later. All right. Gold will keep shining as a diversifier. So we also have got two funds called Gold and General Fund, RHB Gold and General Fund. That's a fantastic fund. We also have a fund called RHB Gold Fund. So these are good diversifying for our clients' portfolios that we always encourage. All right. Now, today, actually, coincidentally, Fund Supermart is also having their market outlook. I don't know whether it's in the morning or right now, but they also coincidentally have it. So I managed to pull this out for you. These are their attractive. You can see from left, it's very attractive. Their star ratings in terms of country and region, and of course the not so attractive. So interestingly, they put not attractive as US. Okay, 2 stars only. So it's got me thinking as well. But I only see fund supermart doing this. All right, so I want to give that disclaimer. The others all seem to say US will do a recovery. They are very hot and very positive on Asia, ex-Japan, but Japan is just next door, you can see. Emerging markets, China, Hong Kong, South Korea, Taiwan. Oh, Hong Kong, okay. Hong Kong for me also is a question mark because of the unrest that has been there since even before COVID. And of course, single country, you've got Singapore, Malaysia, Indonesia, 3 stars, 3.5, okay. But I think Indonesia would do well. So if you have opportunities to invest in an Indonesia only fund, that's a good diversifying. Okay. The others notable mentions will be India, Thailand, Brazil. All right. Okay, so one fund manager that rarely gets a lot of airplay is BNB Paribas. I put BNB Paribas in here because they've got some interesting points. I use the word interesting. Precious metals are starting to rebound. Okay, so it's interesting. I put in my disclaimer here lah. Okay, before you go into for the rest of these slides, for BNB Paribas specifically, if you got extra cash that you're willing to burn, but take a risk on, then maybe you can take note of this additional interesting information. All right. So that is how I would consider this part. So I thought I'd put it in so that you get a little bit more meat. All right. So precious metals are starting to rebound. Gold, they're looking at a 2,000 USD per ounce for 2021. So you might want to buy early. You can buy again. You don't have to buy gold directly. Don't go to Pokong and hoard gold and then bring it, put in your your safe deposit and all that. Just buy the gold and general fund, which is, you can find the information. I will show you actually later. You can see gold and general fund. So you can actually contact us or contact your agent who introduced you here. You can buy a little bit of gold and general fund as well. Okay. Stock market momentum is driven by inflation expectations. So yes, that's actually, it's a no-brainer. They remain positive on, again, you can see emerging markets including China, hello, Eurozone and Japan. Okay, so Japan, I like Japan. Next year, I hope to travel to Tokyo. It's time to reconsider the UK, all right? This is positive for the sterling because the targets are 0.88 pound sterling versus the euro in 3 months. So they see an upswing in the pound sterling, and they are moving UK equity markets from neutral to positive. So I don't know of any specific UK funds, but if you do come across it, if you want to diversify, you can put a bit of diversification there, but do it early. They are positive on small and mid caps. Again, so this one is a lot higher on the exposure, so or the risk factor. So be cautious. I'm just sharing this because it's a good diversifying. Clearly outperformance in December in the US and Europe. So small and mid cap, you want to go in, can, but cautiously. We remain positive for small and mid caps in Europe and US for 2021. Okay, yeah, I mean, it's a fair fact. They are more exposed to domestic economic growth. And with Biden in, I think we can see a positive growth, positive upswing there, because Biden has got a stronger plan than Trump in handling the COVID situation. He'll be willing to take more positive steps, and therefore you'll find their domestic growth would actually be better. The main risk, I just only spoke about this, is it's a COVID infection rate. So the vaccination programs, as they roll out, you'll see the markets to be more positive. So this is the summary of what they are positive on. All right. So let me share with you how 2020 has done. This is based on public information that we've gotten on the RHB fund performances. So this is for you to see how funds have performed for last year for RHB asset management. You can see all the pink color. I hope you can see there's pink. Starting with Islamic global developed markets, this is a very strong US tech presence. It is actually arranged, by the way, it's arranged by the greens at the top are all the low risk funds, low exposure, very, very safe funds, okay? Those at the bottom are the higher risk, more exposure, more equity base, all right, funds. So therefore, low risk, low returns. One of our former CEOs said there's no such thing as low risk, high returns. Okay, no such thing. Hasn't been created or invented on the planet yet. Not invented yet. So we of course always assess, make sure if you are low risk, you also expect low returns. Higher risk, please expect higher returns. It's how you invest. All right. So this is how it's arranged. You can see, let me move this a bit. Okay. Year to date. So this is Jan to December. Year to date, you can see all the beautiful double digits towards the bottom of the screen. And the notable mentions, like I said, Big Cap China. So our Big Cap China, I must mention this. I didn't get to put it on screen, but Big Cap China is actually on the watch list. It is number 11. Number 11 of about 40, was it 40 over fund managers? 40 over funds, okay, unit trust funds around the world. And JP Morgan is monitoring these 40 over China focused funds. And RHB Big Cap China Enterprise Fund is number 11. All right. The other notable mentions on that list would be Principal Asset Management and Eastspring. All right. No other Malaysian unit trust company is there. So only 3 fund managers from Malaysia, or at least you can get the funds from Malaysia: Principal, RHB, and Eastspring. Okay. I think you know what I'm alluding to. So it is good to know that Big Cap China has done extremely well. Okay, so that's what I'm alluding to. That Big Cap China has done extremely well for a Malaysian unit trust fund investing in China. And the next question is, still got potential? Yes, yes. Very happily to say, still got upward potential. So it is not too late to invest. Just give me a second, just take a sip. So Big Cap China, and then the second one is Entrepreneur Fund. Entrepreneur Fund is the Japanese fund, the fund that actually is our dark horse. All right, very quiet but very good. Okay, you can see 22%. Now moving up, you can see Global Allocation Fund, also very strong in US stocks, US tech. Let me jump to the highest one, 50%. Wow, what is 50%? Invest $100 in January, you can get $150 in December, or in the year 2020, the year of global madness. What fund is this? This is Thematic Growth Fund. Thematic Growth Fund was actually very strongly in Malaysian funds, and of course was investing in Top Glove, Harta Lega, was it Kosan Rubber? One more. So they, of course, made a killing last year. But of course, you know now that the vaccine is out, the need for gloves is dropped. Even top glove also, the price is cooled down a bit. So thematic growth, they are looking at new themes. They're looking at new themes. I'm not saying don't invest, but it had a good run. Okay, it's also a good diversifying fund. If you want to buy, you can buy. Okay, put a little bit there. Golden Dragon, China fund. It's a China fund. So you can see 22%. So the others are okay, 6%. Bond, 6%. Islamic Global Developed Markets Fund, again, a US centric fund that's investing in US tech companies. So you've got you've got Amazon, you've got Google, you've got Microsoft, you've got Apple, right? So all those companies you can find in these funds. Okay, you can find in global equity yield, you can find in global allocation fund, you can find it in Islamic Global Developed Markets Fund. So these are good companies. If you want to get hold of the tech industry, you buy these funds, Scout team. All right. So this is how the funds have performed. These are okay. This list is you can even use your EPF and invest. So that is the good part. All right. You don't have to even take out money from your pocket. You can invest using your EPF. Okay. This one is the other funds. Oh, let me move my. Okay. So again, from low risk to, is it low risk, high risk? Oh no, it's not. This is just across. Yeah, you can see the risk of column on the right side, L, and then of course you've got high, and you've got again medium and high at the bottom. So it is not in any form, in any sequence. It's not in any sequence, but you can look at the pink, again the pink sectors in the center year to date. Okay, the pink returns in the center. Okay, year to date, all beautiful double digits. Okay, now I must tell you this: we've done this for 20 years. We've done this for 20 years, and we have seen opportunities like this very, very rare. Okay, very, very rare. But we gave our clients about 6 to about 8% per year. All right, per year, and that's nominal. Okay, we look at different sectors and all that. But this kind of opportunity, I think only twice or three times we've actually had in this last 20 years. Okay, because you have to wait for pronounced drop. Last year was it. Okay, this year you will still see, you won't see a drop, but because everything is already okay, kind of stabilized, you won't see a big pronounced drop, global lockdown. I think we've already passed that. So don't wait for a drop again, pronounced drop like that. No. Okay, we've already passed that. But you can look at recovery growth now. So that is a very important factor. When you hear all the fund managers, you put it together, this is an important factor that you can see. Okay, they didn't talk about wait for a next drop. There's no drop. Okay, you got to wait for, of course, they are buying this, discounts along the way when there are some pullbacks in certain markets, but it's not going to be a global lockdown because we've already learned from that. Okay, so you're going to look at recovery growth this year. Now, the last time that this happened, like I was going to, the point I was going to make was in 2008. Okay, in 2008, what happened in 2008? It started in 2007 when companies like Lehman Brothers, Bear Stearns closed shop last year. Okay, they closed shop last year. They closed shop in 2007 because of the global financial crisis. It started with a subprime crisis, okay, a housing property crisis in 2007 in the US, Orange County in US, and then it spread around the world. Okay, so in a nutshell, in a global financial crisis, a lot of markets took a tumble. It was a systemic failure of the financial market, different from sentimental, systemic failure. It was serious, and markets all tumbled. And Hazel and I went around and we met our clients. At that time can meet clients, now cannot. Now we only meet online. At that time, we went around, we met our clients and we said, guys, this is the maximum pessimism that we've been waiting for. The last one was 2002, 2003. Now is the best time to invest. The fund managers, we have met them and they say the recovery is going to be only in late 2009 or early to 2010. That was the outlook. That means it's going to be a 2 to 2.5 year global downturn, okay, market downturn, because it's going to take a while for these toxic products to be weeded out of the financial system. So that time, maximum pessimism, everybody is like, wow, market drop, Lehman Brothers can close down, Bear Stearns can close down. How, where do we invest? So we got our clients to invest in the same way that we got them to invest last year. And so by 2010, even late 2009, our clients started to make money already. And they continue to be with us until today. So when we meet our clients even last year, they understood. Invest more signal. This is the time. Maximum pessimism, time to buy. And we told them where to buy. All right. So that is what we bring to the table with our 20 years experience. All right. So what you're seeing now, year to date, are you going to see it this year or not? Popular question. I don't know. I don't have a crystal ball. The photo I sent to promote the event, yeah, crystal ball. What? Where anybody with crystal ball? Don't have. Okay. Even Adam Khoo said, you want to buy, you can order the crystal ball from Adam Khoo. He's selling at how many Sing dollars he'll sell the crystal ball. So we don't have a crystal ball, but what we do have, we have indicators. We can't tell you if it's going to rain today, but we look at the barometer, we look at the trends, we know we are in the, which part of the world. We know that, okay, there is a probability, you carry your umbrella, you go out, if it rains, you are saved. But we can give you within a certain range. We know that this is how the markets are going to go. So if we do see that all the fund managers have given indication that this year is going to have economic growth, economic recovery, therefore you want to invest after the recovery or before. So it's important to know. Okay, I don't want to take too much time. I want to move on. This is, of course, our Islamic International Asset Management fund performances. You can see below there, Sharia China Focus Fund, 45%. You know, amazing. All right. Okay, so I just want to give you a quick view of, these are some of the people who have invested with us over the years, and they have actually written in and given their testimonial of our services for them. So you can quickly glance over it. I don't want to spend too much of time on it, but these are clients who have given their testimonies. One of them is, I think, tuning in here. I won't mention names, but hope you can see your handsome face. Okay. Top 8 assurances. Okay, a lot of people want some element of certainty. These are the top 8 assurances when you invest with us. There is a trustee when you invest in unit trust funds. Each approved fund has a trustee who is a custodian of the fund. So what is your assurance? There is a check and balance. Okay, distribution of authority makes it a safe investment option. Okay, when an agent resigns, what happens? There is a clear process to assign a new agent to manage your portfolio. Therefore, we are there with you for the long run. Okay, some of you are actually clients who have been passed to us because an agent has either moved on in their career or so on and so forth, and we've actually connected with you, and you've actually made good investment, good money with us. So that's important assurance that you have with us. So our local provident fund also has approved and encourages UT investments for the retirement savings. So very important validation, okay, that you get from our local provident fund. Okay. Now, very important compliance and updates. We have and this is something our clients sometimes complain, why so always change the forms? It's important because it's a compliant process. Okay, when we change forms, it's banking changes. Some of you have received an update, a form to update your email and your phone number, because the bank wants to make sure you're in touch with them. And of course, you're in touch with us. Therefore, these tightened controls provide more credibility and product quality. And remember, only licensed agents and regulated with FIMM are allowed to distribute unit trusts. So accountability and competency are to serve your needs. So Hazel and I, and of course, a lot of the consultants here are licensed to actually serve you. And the funds that we offer are only the approved funds. That means funds that are approved by Securities Commission. And therefore, you can invest, they are invested into safe instruments because they are approved. And always remember, the unit trust management company is a willing buyer. That means when you want to dispose of your units, you need your cash back, you always have a willing buyer to buy back your units for your unit trust. All right. And any changes in your portfolio always need your approval. If the fund manager wants to change the fund objective, they always have a unit holder meeting, and they always inform you that there's going to be a unit holder meeting. So that kind of transparency and is very important, and that's one of the assurances that you have when you invest with us. All right. Now, I'm going to pass it over to break the monotony. I'm going to pass it over to our agency development manager, Mr. Lim Beng Ju, who is going to talk to you about the sustainable fund that we have featured this month. So let me quickly bring him up. Lim, are you ready?
Hi, Patrick. Yes, yes.
All right. So you want to?
Yeah, I would like to share my screen here. Patrick, you have to stop sharing your screen first. Okay, can you guys see the screen? Okay, very good afternoon, everyone. Yeah, my name is Lim. I'm agency development manager of R.I.C.H Asset Management, based in KL. Thank you, Patrick. Thanks to Patrick for inviting me for this sessions. So I won't take much of your time today. So I'll just run it quickly. Just share with you this one of our new funds that was launched early this month. Okay, so it's actually R.I.C.H Global Sustainable Disruptors Fund. Yeah. All right. So basically, this fund is a collaboration between R.I.C.H Asset Management and JP Morgan Asset Management. All right. So I don't have to introduce much who is JP Morgan. I think most of you know who is JP Morgan. So we are collaborating with them for this new fund. So what is so good about this fund, right? So first of all, of course, this is an Islamic fund. All right, this is a Sharia compliance fund, and of course, this from the name itself, you can see that it's a disruptors fund. Okay, what do you mean by disruptors? So basically, this fund will invest in those sectors that will disrupt the market. Yeah. So what are the things that will disrupt your your daily life. So we can talk about digitization. Yeah, digitization like AI. AI will disrupt your disrupt meaning will change your life. Yeah, will change your daily routines. It can be cloud. Yeah, cloud. I believe all of us are using cloud every day. Yeah, like be it iPhone. iPhone you need cloud to keep your storage data. Yeah, or Google Drive. That's considered cloud. So of course, to keep all the data, you need a data center. Yeah. So all these are digitization that will disrupt the market. Okay. So of course, financial evolution. What do you mean by financial evolution? You know about digital banking. Yeah. You talk about NPay. You talk about Alibaba. Yeah. All these digital banking. And recently in Singapore, they have approved a few digital banking like Grab, yeah, C Corporation, all this considered as financial evolution. Of course, feeling good. Another themes that we will be looking at is feeling good. Feeling good is something like a new economy. Yeah, just now Patrick touched about consumer discretionary. Yeah, so we will invest into those luxury goods. Yeah, those feel good, something that can make you feel good. Okay, and of course, healthcare innovation. Now you with the pandemic, all this, a lot of people scared and worried, want to go to the hospital. Yeah, so instead of you go to the hospital and get diagnosed with to see your doctors, so you can do all this telemedicine. Yeah, I think Sunway Hospital came out with this telemedicine. Yeah, it's one of the innovation that they are doing in healthcare sector. Okay, and of course, energy revolution. Just now Patrick mentioned about Tesla. Yeah, we want to talk about some and also Patrick touched on the cyclical sector. Actually, any energy sector is considered one of the cyclical sector. Yeah, so we talk about energy electric vehicle. So this will change the future of human, right? Like solar energy. This is what was preached by this new president, new United States president, right? He's very into all this green energy. Okay, so all these are the disruptors, meaning that will change the future. Okay, and of course, with the disruptors, we also focus on ESG. Just now, Patrick mentioned about ESG. What's ESG? ESG is basically E meaning environmental, S meaning is social, G is governance. Yeah, environmental, I don't have to explain much. It's about environment, climate change, all this. Social is about your the employee of your companies, the clients, the suppliers, yeah, and all this related to your companies. And governance is about your management team, yeah, your shareholders, all this. So why is it important to invest in to focus on ESG? I think in Western countries, they take this very seriously, ESG. Okay, in Malaysia, I think we are starting to adapt to this. Yeah, I think Bursa Malaysia came up with this ESG index, I think towards mid of last year. Yeah, so they can see the importance of ESG. So like I think few months back, why is it important? Why ESG is important? I quote you an example. A few months back, I think most of you know a company which I don't in Malaysia, which I don't want to name it, okay, because of the workers mistreated, okay, so their company share price affected, okay. So that's why we talk about sustainability. Why sustainable? With this ESG, we can ensure that the company is sustainable. I mean the share price, the share performance. Okay, so with this sustainability, you don't have to worry that this company performance will be affected by all this ESG. All right, so that's why ESG is very important. This is one of the screening because this is Islamic Sharia compliance fund, so it will be screened against the Sharia compliance committee. Sorry, okay. So there's a committee that will screen through all these companies so that they meet the criteria. Okay, another screening is through ESG. So ESG is something like there's a rating for ESG, like bond, like your bond or like bond. There's a rating, right? So ESG, there's a rating for it as well. Okay, so this is why we emphasize on ESG. Okay, and of course another points for this fund is unconstrained. Okay, what do you mean by unconstrained? Unconstrained meaning there's no limit to this where to invest, what to invest. Okay, you can invest in emerging market, you can invest in Europe, you can invest in US. Okay, that's why it's called global. Yeah, and of course there's no limit to which sector they want to invest in. So it depends on the team. Okay, now they think that digitization is the theme that will disrupt. So maybe moving forward, it can be another sector that can disrupt the market. So they will change. Okay, for now, this will be the 5 main key disruptors team. All right. So of course, information advantage is about the JP Morgan's. How good are they? I don't have to explain more. Okay, so these are the key benefits that for these new funds. Okay, I think most of you have been briefed by your consultants. So I just want to recap a few points for this fund. All right. Okay, Patrick. Okay, Patrick. I'll pass back to you.
Okay, thanks. Thanks, Lim. Give me a second.
Let me stop sharing.
Okay.